Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is August 17th of 2021. We're going to talk about three topics moving markets, and we're paying attention to it here at Blanke Schein Wealth Management, so you should too. So thanks for watching. So as I film this today, markets sold off today, and this is a Tuesday, but yesterday we had some intraday highs and some closing highs, all-time highs on some of the indices. And so they were shrugging off ultimately what was a very unstable geopolitical environment and backdrop around the world, to say the least, this last weekend. So that's where you really can't say, hey, listen, does the geopolitical events translate into markets or affect markets? But actually, that wasn't really the headline that drove markets down today specifically. It was the big box retailers and some of the sort of sales numbers that we got that was showing that the consumer has done exceedingly well, but they actually, their sales have been down, or their spending specifically has fallen but 1.1% in July. And so that's really understandable right now. We can see that trend accelerate, especially in light of the geopolitical events. Makes more people insecure about their surrounding. Less confidence means less spending on the consumer side. But on a go-forward basis, that's the one to watch, and we will watch that very closely. But we do know that the consumer is rich with cash. They have money in the balance sheets, in the banks, and they're using that, if not in the retail space, they're actually using it online, as we saw e-sales, online sales just explode. Every corporation that's reporting right now has just shown the year over year and exceeding expectations all across the board. And it's really something to see. Like we said before, the technology is pulling forward years of growth. And so we can see the consumer, whether they go out or stay home because of the new variant. And that's sort of the noise right now that's sort of keeping the retail sales, at least that's what the analysts believe, that's what all the corporations, all the CEOs are saying, is that they can see some sort of slowdown in traffic, therefore slowdown in sales, and that's where we're seeing that from the new Delta variant. That being said, let's look at the other side of that, the corporations. Now, interesting report that I read in the Wall Street Journal this morning that basically showed that in 2015 on U.S. corporate balance sheets in cash, there was a total of $4 trillion, just over $4 trillion. Well, fast forward 5 years ahead, a little bit more than that, you're at 6.84 trillion, and we just went through the largest global pandemic that we've seen in 100 years. And so that really equates to 45% increase in the balance sheet, or the war chest for corporate America, which is tremendous. Or even this last quarter over quarter, a 2.6% increase in the cash for U.S. corporations. Now that's accelerating, and that's what that's what's telling us. And now what are corporations doing? Well, they're using the capital markets to raise capital. They're obviously refinancing debt. They're doing a lot more with less in terms of employees, because we saw the unemployment rate higher than ever. They're trying to hire back, but there's a lot of people that's still holding out there in the labor market. So that's an equilibrium that still has to work its way through. But there's also technology, right, that's making the balance sheets a lot stronger. And so those corporations, those executives, those CEOs are basically saying, hey, wait a minute, there's all this uncertainty. Last year we had the election, and then we had obviously the virus. And then you go into geopolitical events like most recently, and then you go into the expectation of corporate taxation. Corporate taxes are going to rise. It's no wonder that corporations are saying, wait a minute, let me pump the brakes on this and let me just hoard my cash, and then let me see how this all shakes out, how the virus shakes out, how the corporate tax sort of policies shake out. But I will tell you, this is a very significant number right here. The $6.8 trillion, will probably be $7 trillion by the time we're done with regards to the sort of hopefully the pandemic, if you will, on a go-forward basis. Why that's significant is that don't ever forget that it's going to unlock sort of the animal spirits built into the U.S. capital markets. And so what happens is natural competition, that one CEO sees that somebody else in their same sector, their space, or somebody who's a competitor across the street makes an acquisition with all that cash, right? We will see M&A activity pick up. And so once, let's say one company buys a smaller company, then you, if you're the competitor and you've got cash on the balance sheet, your shareholders, your board of directors, your executives, your employees, everyone's going to look at you and say, okay, it's your turn. And what happens is that war chest right here is going to sort of spur another economic growth cycle And so that's really encouraging on the underpinning of the healthiness of U.S. corporations on a go-forward basis. They've already proven that they can make money with less people. They can make money online. They can make money in a pandemic. Again, don't forget, in 2020, the U.S. S&P 500 earnings was actually up just over 2% on an annual basis, like year over year. That's like unheard of, right? We stopped for two and a half, 3 months and shut down the world, economically speaking. So corporations can prove that they can make money. They can also save money, and they're going to build that war chest until there's certainty ahead. But the animal spirits, one corporation's going to basically stick their neck out first and jump in and say, okay, they're going to take advantage of first movers advantage from this point forward. And that's going to be a good sort of another leg up for the markets. Now, in the meantime, as we get through this period of uncertainty, and keep in mind, it's the summer, everything's slowing down. We get past second quarter earnings. Third quarter earnings are sort of like, everyone take a breath. If you know, historically speaking, anywhere from August, September, October, we kind of sort of wait for our last opportunities of the year, meaning that markets pull back by 5-10%. It's not uncommon. It's actually seasonably expected. But we here at Blanke Schein Wealth Management have a lot of cash on the balance sheets for our clients and our portfolios, and we're going to deploy that strategically when these opportunities present themselves. And trust me, they certainly will. In the meantime, what are we looking for? Well, we're looking at the S&P 500. So we also want to look at sort of the statistics built in, as well as sort of the moving averages and some of the key metrics that we follow. And so the 50-day moving average right now, as we film this, is 44.47 as of today. Today's close, just somewhere in there. But the key moving average test, the 50-day moving average of the S&P 500, is 43.37. So if we go down from here, the 4,400 level to the 4,300 level, and we don't bounce, then that means that there's going to be some trouble or some seasonably sort of drawdown, that we call that in our sort of industry jargon, if you will. The drawdown is when we take advantage of it, because we believe that there's cash on the balance sheet, there's more stimulus ahead, the economy's strong, interest rates are super low. There's a lot of belief that we're just waiting for opportunities for the markets to pull back. And when they sort of hit the 43.37 level and they go low, if they go lower and not bounce, then we go to the 200-day moving average. And currently, 85% of the S&P 500, so we take all the constituents, all the individual companies, and we look at their daily trading, their 85% of them together, their average is above the 200-day moving average right now, which is key, because if we get to sub 80%, so less than 80% of that collective group drops below the 200-day moving average, then you're breaking down from two technical levels, two perspectives, right? You breach the 50-day, and now you're going to breach the 200-day. That's when you will then see a 5 to maybe 10% correction, at which time we've got our high conviction list here, and we deploy the cash to what we believe, whether the already existing positions that we love, well managed, will execute on the short-term pullback and drawdown. We will jump on those. And it's actually a wonderful day, because when we go shopping, because we're long-term believers in the equity markets, we're we're long-term bull. If you have especially a time horizon that's longer than 2 to 5 years right now, we see a lot of great opportunities. But we always take advantage of that when markets get tired, and as they often do, seasonality at the end of the summer, beginning of the fall. That's where we are today right now. That's sort of, in our mind, what we're paying attention to and what the market's paying attention to right now. Obviously, the geopolitical environment could heat up, and hopefully we pray that it doesn't unravel and get worse than where it is today. But we will pay attention to this and keep this on top of mind, as markets will too, on a day-to-day basis, on a go-forward basis, and then react accordingly. That could be the trigger for these two moving averages. That's what sort of why I wanted to bring it to our attention today, for our viewers at home, to say, hey, listen, what are we paying attention to? What really matters most? Why do we have confidence on a go-forward basis? But in the meantime, we could see some tests of the moving averages, and if we do, we're going to take advantage of that. So thanks for watching today. Again, like and subscribe, and share this with friends and family if you thought it was worthwhile. And if you wanted a review of your portfolio, we're all here for you at Blanke Schein Wealth Management. Looking forward to it. Take care. Have a great day.